Hi everybody, this is a special edition of Liquid Lunch. It's me, Hugh Riley, and I've got Martin Charney joining us. Not the first time you've been here, Martin, so welcome back to that channel.
Thank you.
And we're going to be talking about at least to me, it's a new concept. And this is really a concept that's going to help people who want to buy homes who may not, using traditional means, being able to get them. But this is, to me, this is a very unique concept. So it's called Home to Own, H2O. Do you want to maybe just give us an introduction to the concept?
Well, the concept is basically to help those particular buyers that need to buy and want to buy, but they cannot close immediately. In other words, they need a breathing space of some time, 2 or 3 years, in which to save a shortfall monthly and or repair their credit.
Mm-hmm.
They've got a good combined gross annual income, but they don't have quite enough. So, for instance, they may be short of, let's say, $36,000. So they would save $1,000 a month over 36 months.
Okay.
And there's no more than approximately 3% annual price escalation between the present purchase price and the future purchase price.
Yeah.
So a typical house of, let's say, 500,000 will close at 545 or very close to that.
Mm-hmm.
So that means the occupant, the buyer that's moving in to the house that he's chosen, he will know exactly what he's going to buy the house at.
Which is great, especially with the market these days.
Correct.
So I would just like to give an overview of how this works, because I think people, at least the way I work, is I'd like to understand the overall concept, because it's got to be win-win-win. It's got to work for everybody, or I don't believe it, right? So basically the concept is that, so somebody wants to buy a house, but for whatever reason they're not going to qualify. Okay, so what happens? So they can make the deal and they can move in today. Is that right?
So the first thing that happens is they call me up and I hear them out. I do a very quick analysis based on salary, down payment, and credit.
Mm-hmm.
If I like the sound of them on the phone,
Mm-hmm.
I give them the pleasure of sending them an application
Okay.
where I ask all the gory details.
Mm-hmm.
Then I get the application, I look at it carefully, and if I'm still happy with what I see, I send it to our in-house credit counselor lady,
Mm-hmm.
who is going to be running with them throughout the period.
She's
for
going to
3
be
years.
essentially mentoring them to
Mentoring
improve
them.
their credit.
Setting them a budget
Yeah.
and helping them go from, let's say, 550 to 700.
And what some people don't realize is if their credit is good when they go to get their mortgage, they're going to be saving thousands and thousands of
in
dollars.
interest.
Right?
Correct.
So that's a great benefit just alone, is to help them
Right.
repair their credit, right?
Right. Now, once we've got to the stage of our in-house credit lady saying, yes, these are very strong applicants, buyers. We don't use the word tenants, but call them occupants.
Mm-hmm.
We then go and get their down payment, their deposit. We put that into the trust account of the realtor. Maybe they have an existing chemistry with a realtor.
Mm-hmm.
And only then do we let them loose on the market and let them buy a house. But they don't do the buying.
Mm-hmm.
We bring one of our investors who are qualified to buy the property for and on behalf of the occupant,
Mm-hmm.
so that the investors that I have are wealthy and with good credit.
Mm-hmm. And they're
So
looking for a safe place to put their money.
Right, and they can therefore get their mortgage fixed over a 3-year period at a very good rate. At the moment, under 2 3/4. The rates went up. It was 2.45 or something. Now it's still very much less than what the average buyer can get it at.
And in a sense, those buyers or your occupants, they are benefiting from the great credit rating that your
Correct.
investors have. Right?
Correct, exactly.
Okay.
And that's important because, there's 3 reasons why they come to us. One is not enough down payment. Number 2, not enough credit. And number 3, there's very often an undervaluation on the appraisal. So they bought for 500, bank says, forget it, we only think this place is worth 450, irrespective of bidding wars or not. We're not going to give our 80% based on 500, we'll only give 80% on 450. So for whatever reason, it collapses because the buyers often need a big mortgage of 90%.
They have to make up that difference anyway.
Right. Whereas my investors put down 20% and they take a mortgage of 80. So there's no CMHC wasting insurance money. It's a very clean, strong deal. And that allows the occupant to have time, up to 3 years, in which to save each month his down payment. Now that savings is going to the pocket of the investor temporarily as a prepaid profit, without which the investor would have to wait 3 years for any profit. But that, let's say $1,000 a month, if there's a shortfall of 36,000 over 3 years, is credited to the occupant, so that they owe that much less each month on the purchase price. And that is really the essence of the structure. We have a maximum, approximately a maximum of 3% from the present purchase price to the future purchase price. And
so that's the price from the difference between what the house is purchased for now by the
investor from the seller,
and the price that the buyer in 3 years, the
will
occupant
will
pay. So in a market where we have really crazy escalating house prices, they're guaranteed only 3% approximately increase per year.
Not only, but yes, the investor gets he earns money in 3 ways: on the up and the down. The up is the escalation in price, and the down is the mortgage reduction, because then he owes that much less to the bank at the end of the time.
Right.
The other, over and above the up and the down, is the cash flow.
Yeah.
That monthly saving.
Yeah.
Which is temporary, but it's nevertheless very important in the minds of some investors. They want to know that they can live well and they got a cash flow of 500 or 2,500 a month. Now, obviously, the more the occupant puts down, the less he has to save every month. But he's got to save a minimum of 10% of the future purchase price plus his closing. He's got to save that less what he's already put down. And that figure divided by 36 is the monthly savings.
So, I mean, this is, I used to sell real estate. I was sort of telling you before. So, in often, at least in the market I was in, wasn't as hot as this market here. But still, it's a real tragedy for a real estate salesperson who's trying to put a deal together on a house to have to say the deal's not happening because the buyers just can't get the financing to do the deal. And what you're saying is that in this instance, those people that otherwise just don't qualify, the people that the realtors can't help, but now they can call you and they can actually put the deal, they can move into the house right away.
And we give the realtor a second bite at the cherry to earn his full commission. We don't take a penny from the realtor, and we don't take a penny from the occupant. We get paid by the investor. And the investor is more than happy with his return on investment, even though he's paid his closing costs, he's 20% down, and he's paid a small admin fee, so we can run the business.
Okay. Now, we were talking about this, it's almost as if, well, what about this idea? I mean, for example, I'm just thinking about the what happened in the U.S. with the ninja mortgages back about 8 years ago, and the idea that that situation was allowing people who shouldn't really be buying houses to buy houses.
Right.
But this sounds like it's not like that at all.
The philosophy of H2O, which stands for water, which is to help things grow, help life grow, not die. In other words, I want to continue with a zero default. I'm going so far as to say that we don't let a guy move in unless he's got a life insurance policy that he either owns himself already, or we sell him one that is collaterally assigned to the investor. So if, God forbid, the husband of the occupant passes away, the investor gets all his money back, and the wife gets a free house paid for by Manulife or whichever company we may be dealing with.
And that's part of what you're bringing to the table.
The ethics and the clarity and the transparency and the decency of the whole deal. Because although I was a real estate broker for 25 years, I employed 40 people in Johannesburg. Here, a lot of rent-to-own operations are owned by realtors, and guess what? All they care about, and I hate to admit it because I was a realtor, is their commission. But I take my full fee only at the end of the period, the term, to make sure that there is no default. I run a checklist to see during the term, is he submitting his bank statement and his Equifax credit report? Is he sticking to the budget that my internal lady set with him? And is he cooperating? Because I don't want to have, call it blood on my hands, that a family was evicted, children, mother out in the street, and they lost their full life savings plus their monthly down payment.
And now the house that was all supposed to go in.
And the investor would love that in some instances. I don't feel we've got such ruthless investors to want to cancel right at the 11th hour. But the occupants are very motivated because in all likelihood the prices will be higher than the future purchase price based on the 2.5 or 3%.
Because you're limiting the price they're going to pay in 3 years.
Right.
So even which is because some people are freaking out that they're going, I need to buy now. I don't know what the prices are going to be like in 3 years. Exactly. So here they can actually do that or kind of do that, but when they do buy, they are limiting the price they're paying in 3 years, maybe substantially below what the market at that time will
That's a risk that either take, and the investor takes that risk. I mean, the occupant does have a legal contractual obligation to buy it at the future purchase price. Otherwise, they're going to walk away from their down payment and their deposit, and they may have even improved the property, put in furniture that fits exactly, carpeting, whatever. And it's really their dream home that they have chosen. They don't have a tenant mentality that the tenant doesn't care. Right. They have to maintain and repair everything, appliances, roof, etc.
You know, that's why I say, some people say there's a natural rate of home ownership in the economy. But, you know, the way I think it's like, if people live in their own homes, they feel more, they're more responsible citizens. They're, you know,
that's why the investors are willing to come in and out. I mean, they could buy the house for themselves and qualify a tenant and put in a tenant and keep that full profit. But that's a lot of work. And they may have a tenant that doesn't care and would mess up the property. So there's much more risk. But there's also potential benefit because the prices have been going up 8, 10, 15% depending on which area. Now, the other aspect of my program is that we do not go much above $1 million as a future purchase price, because how much lower can a house go at 500 or 600,000 if there's a turn? There may be a temporary price correction in the market, but a 500,000 house can go to 450, whereas a one for $1.5 million can go to 900.
So you're saying those higher priced homes it's more elastic, the price?
Yeah, more risky and more volatile than the cheaper ones. And I also think that's a bit of a chutzpah, a cheek for a buyer who cannot close immediately, hasn't got enough money to want to buy a house for $1 million or $1.5 million. My program's not for that. Neither is my program for people that want to put in a tenant. And they want to buy for you. It's for a family that wants a garden, a lot, as you call it, for the kids, a nearer school zoning. They don't want to have to be pushed out continually by the landlord.
Right.
That's what I have in mind.
And this is open to almost or everywhere in southern Ontario, or
Yeah.
do you want to just say what?
It's open to within a 2-hour drive of here, because the investors are keen to want to be able to go if they need to go, as opposed to I did one in Edmonton for 1.8 million. The buyer was putting down $250,000 twice, once on acceptance and then another $250,000 in 8 months. But I couldn't whet an investor's appetite to go to Manitoba. And it was a harder thing to get a mortgage because it's on a sliding scale when you go over $1 million. So from experience, I've decided, until I'm doing 5 or 6 a week, I want to stick to Southern Ontario at under $1 million future purchase price.
Well, that's pretty much a 2-hour drive is pretty much your GTA catchment
London,
area.
London and just this side of Ottawa, Brampton, Hamilton, Durham area. Those are the catchment basin.
And Niagara?
And Niagara.
I have to say that because I'm from Niagara.
Okay. Welland has been quite depressed, but
That's my hometown, by the way.
but
It wasn't my fault.
by the way, my son works for GE,
Okay.
and there's a big GE plant coming there with hundreds of people going to be hired. And it's public knowledge. I'm not giving away any secrets, but that's going to give growth and property price escalations to that particularly slow area at the moment.
I got to say, it was a great place to grow up.
Yeah, for sure.
They got great schools, great people.
Right.
It's a nice city.
Trusting, everybody knows each other, and small town.
I mean, it's got its other side too, but that's good for you too, right?
Right.
It was seriously a great place to grow up, and
No, but that's why I'm restricting it. I'm not going to Thunder Bay and far away places,
yeah, okay,
because I've got to be fair to my investors
yeah,
and my occupants. It's no use just looking at the one side, because the investors are really the basis or foundation of the H2O program.
Now, so again, let's just describe who the ideal occupants or purchasers here are.
Somebody with, let's say they want to buy a house for 500,000, they've got to have 4%. Those are 20 grand,
Yeah,
which is not a lot. And they've got to have a gross combined annual income of 95,000.
they have to have that now. So
Yeah.
they got to have that 20,000
Correct.
in the bank or
Yeah.
available.
And then their monthly saving would be about $1,235 a month, which would mean they would then have saved 10% of the future purchase price plus their closing costs.
So they have to be in a position where they can put that money away every month for 3 years.
Well, it goes into the pocket of the investor, as I say,
Yeah.
but it's credited to them.
Yeah.
So again, both people are winning.
Now, now this sounds like such a great concept. It's hard to believe that people haven't. I mean, I'm just hearing about it now, but it sounds like a really good concept because it works for everybody. It works for the
Right.
investors. It works for the buyers. It works for the real estate people.
Correct.
How did you? I mean, can you tell us the story about when you heard about this concept and when you decided to put this together as a business?
I've been in it now for about 3.5 years. I learned about the concept originally in South Africa. It was called installment, deed of sale on installment, which gave the buyer up to 3 years.
Okay.
But here I learned that it also works, but I have made certain modifications. For instance, life insurance.
Yeah.
And people were laughing at me at the beginning. They said, well, why must I take out a policy and assign it to a stranger known as the investor?
Mm-hmm.
I said, guess why? Because if, God forbid, your husband passes away, who accounts for 60% of the gross combined income, you're going to be on the street. You're going to be evicted.
Mm-hmm.
You're going to lose everything.
Mm-hmm.
So the 10-year term first to die policy is very, very cheap.
Mm-hmm.
Let's say he's 40, she's 35, and they're both clever enough to be non-smokers.
Mm-hmm.
The premium is under $70 a month.
Mm-hmm.
So that way, on a price of 500, the default price, the future purchase price is 545 plus the closing is 550. So there we would take a policy of 700,000. So not only would she get a free house paid for by the insurance company, but she would come out with 150 grand of small change, all for a premium of under $70 a month. So I don't want to have any objections. If anybody gives me an objection to life insurance, they didn't grow up with the concept, cheers, they're not for me.
Mm-hmm.
We say no.
Mm-hmm. And let me ask you kind of a worst case scenario question. Assuming that the occupants, the purchasers, come in and you approve them and they get into their house, and how can they screw it up?
First of all, they can go crazy. They can raise the house to the ground, mess it all up.
Yeah.
They can just sit there and make their default and the eviction difficult.
Yeah.
I'm actually going to be applying to the rent board for a new category of people called occupant, because if there's a category called occupant, it'll be easier for them to get a mortgage. Because right now they're either on title as the owner or they're a tenant. Now my guys are neither, because a tenant puts in first and last month. My guys are putting in 50 to 100,000 down. My occupants have to repair the whole thing if anything goes wrong, and they pay the mortgage, they pay the taxes, they pay the property insurance. They don't pay a rental, and they have an obligation to purchase, not an option, where tenants sometimes don't have to exit. So it's a completely different animal from a tenant. But worst case scenario is, yes, the house will be messed up, but that's a clear case of the occupant being in default and he'll get evicted. But the owner, the investor, remains on title. Worse than that, I cannot imagine, because there's insurance. If there's lightning or terrorism or whatever happens, insurance should cover it. Fire.
Okay, so now who do you want to get in touch with you about this? Because there's different stakeholders in this whole scenario. So obviously the buyers, the occupants.
Yeah, currently, because I've structured it so conservatively, there's a lot of investors, because they're on title, they get a very good return. I'm looking for that narrow strata of buyers that are better than tenants, but not as good as cash buyers that can close with a mortgage.
Right.
And all the buildings, the blocks of apartment condos that we see around are full of people that may have 20 or 50 grand and a good income, but they don't know of either this concept, or they just haven't been approached in the correct way. They've been told by realtors, you don't qualify and we'll see you another day.
And maybe it's time for them to really get a house. Maybe they got kids on the way or something like that,
Right.
and they got to kind of move to the next phase.
Because it's a terrible
right?
thing to be evicted and have to change school zonings every Monday and Thursday because of a landlord wanting to move in himself or sell the property.
Absolutely. Especially for certain kinds of kids that
Right.
need that kind of stability, right?
Yeah, exactly.
Yeah. Okay, so you got enough investors, but maybe this concept's going to go so huge that you're going to need some more investors. I guess they can get in touch with you if they.
Yeah, I'm always looking for both. But right now, I've had a number of investors phone me up, Mr. Charney, what's happening? We got this 120 grand burning a hole in our pocket. Can bring us a new one, another one. But it's a matter of ramping up the market, the marketing, and doing it. I know that there's about 8 competitors, major industry, this rent to own. And I feel that mine is the most transparent and the most decent and ethical program, because I'm looking at it from both points of view.
Yeah, you're not just in this for the money, like
For the commission.
Yeah,
Right.
You're actually in here. You're looking to really help families and get them into houses, and
I feel a debt to my investors because I know most of them,
yeah,
and I'm looking for, as I have multiple investments from each wealthy person that I'm dealing with. So, the most important thing in business is to have a good reputation, a good name, because once you have that, you get people referring you, you get warm leads, and the thing snowballs.
Okay. Now, is there anything else we need to mention here today
Not
that
that
you
I
want to
can-
get up?
Not that I can think of.
So you know who you are out there, that you need to get in touch with Martin. And we've put the website up there. It is home
Home to own H2O.
home2own h2o.com, and people can get in touch with you there, I guess. Martin, is there any other contact info you want to give to people?
My number is 416-524-5518.
Perfect. So get on the phone right now and call Martin up. 416-524-5518. Okay, Martin, this has been
Thank
great.
you very much. Thank you.
you for bringing us this information.
Very
And
good.
best of luck to everybody out there who's now knows how they can get into that house that they need right away. So thanks for tuning in here on Liquid Lunch. We'll see y'all next time here on thatchannel.com.